Andrew Holland as well joins in. Andrew, hi, morning. It's the Larry Summers effect on the markets, but the point is, how long is it going to last?
I think we're reading too much into Summers not being the Fed chairman. I mean, it's for sure we're going to see Fed tapering, and you know, everyone's getting towards this $5 to $10 billion, which you know, to be honest, is what I was expecting anyway. So I'm a little surprised the markets are getting ahead of themselves on this. For sure that you know, this is not just a one-off event, and I think that's how we're looking at it. That, you know, a bit of tapering here, we're all back to where we were. But you know, I would have thought if we're looking at a more dovish Fed chairman, then you know, U.S. growth will continue to pick up, and similarly in Europe as well. So interest rates, if anything, are going to continue to harden in developed markets. And I still see the bond yield in the US going towards 3%. That's the 10-year bond yield. And I still expect the dollar to strengthen. So, you know, to say that we're out of the woods is really, I think, a fool's game at the moment. So I'm not trying to throw, you know, water on this kind of nice rally we've had. But to my mind, and I think Nikunj mentioned it, unless we see some big bang changes in India, you can be assured that foreign investors are going to say, well, nothing's really changed in the emerging markets, which make me more, you know, more bullish in terms of the structural problems that they have. And if anything, the risks remain in places like Indonesia and Turkey, you know, which could come back to haunt the emerging markets. So, you know, India will benefit from this in the very short term, and we'll probably see the rupee maybe trading around the 62 to 65 range in the very short term. But the problems for India, you know, remain, you know, very severe. And you know, people keep saying, is this a, you know, a bear market rally? I think it's a bear market rally in the broader market. I don't think the market's really been in a bear market whatsoever. So, you know, enjoy it while it lasts, I suppose.
Andrew, how does one approach names like Ranbaxy? Because the problem with the pharma space is, while it may be a great defensive, but it's extremely company-specific a story.
Yes, it is, and it's as you've rightly pointed out, it's probably for some companies it's a sector to avoid. I mean, we've been very careful in our picks in pharma in the past, obviously keeping to what we believe to be you know, the better managed and you know, less likely to fall foul of US regulations. So, you know, Sun Pharma, Biocon have all been part of the portfolio, and they've done exceptionally well. But I think, you know, if I was to look at the sector which I continue to like, is the IT sector, despite the valuations. And again, I'm going to go into one stock here, which is Tech Mahindra, which I think is going to be a, you know, significant re-rating over the next few years. So, you know, that's the kind of play I have there. Consumer stocks now, we've really kind of moved out of most of them, although United Spirits and Tata Global Beverages remain on our kind of buy list as something that's changing within the sector or for those companies. So we've moved away from a little bit from defensives, got a little bit more constructive on the kind of some of the more kind of interest rate sensitive sectors, partly because they were beaten down so much. But again, we're back to our, you know, let's rent them rather than own them at the moment. There's too many problems in those sectors for the rally to have really justified the kind of move up in some of these stocks.
Okay, along with Ranbaxy, Wockhardt also has taken a knock, and a sizable knock. Both Wockhardt and Ranbaxy had two things in common. They had fallen very sharply because of US FDA problems, and some HNI investors, they bought into Wockhardt and Ranbaxy thinking that valuations were cheap and the US FDA problems were slightly over-exaggerated. But now that Ranbaxy has received an actual import alert, That I'm sure will have impact on Wockhardt, Strides. I want to look at Strides as well, because there also is an issue of US import alert. No import alert has come, but a 483 certainly has been come on one of the manufacturing units. That's Strides for you, which also has taken a knock of about 4%. Andrew, why are you bullish on Tech Mahindra? Because Tech Mahindra is no longer a cheap stock. If I look at the 1-year price chart or the 6-month price chart for Tech Mahindra, it has seen a significant amount of re-rating.
Yes, it has, but it's still trading on a significant discount to the big majors in terms of Infosys and TCS. So I think the re-rating was partly to do with the fact that we now have size. In terms of a company which can go and compete effectively. And I think the synergy benefits have yet to be played out. So we might, hold around these levels. Yes, you're right, it has had a reasonable run. But I think over a 1 to 2 year period, I think we'll see those ratings continue to move higher, compared to an Infosys and TCS. So we remain, very bullish on the stock over a 2 year period, a 1 to 2 year period, that is.
Andrew, the basic argument which has favored IT stocks is the currency movement. There is this correlation trade. If rupee goes down, IT companies will make money. Now that rupee has recovered, do you think the tailwind for IT sector in the medium term could be missing?
No, I don't. It's quite interesting. I mean, if we go to before Bernanke spoke on the 22nd of May, I think the currency was, about 54, 55. So we're still at 62, 63, which obviously benefited the IT companies. I mean, we did get to 69 at one time in terms of the rupee, but that was really just for, a day or so. So I don't think IT companies benefited that significantly from the move from, say, 65 to 69. But obviously they will continue to benefit when the currency is around 63, 64. So I don't buy that argument, and my argument is certainly strengthened by the fact that I expect bond yields in the US to move towards 3%. I expect the US dollar to continue to rise, and therefore, emerging market currencies will remain under pressure going forward. So, this is, to my mind, just a short-term rally in the Indian bond market, and the currency on the back of global events. And those global events are not going to get better for emerging markets in terms of interest rates, and liquidity remaining, so benign. So, don't bank on that as being a forward-looking kind of rupee move, because we're going to have to attract foreign direct investment, and we're still not doing it, and we're not doing it on a significant basis. So as long as we keep to portfolio flows, then obviously we're going to be subject to what happens globally. So big bang for me is cut interest rates and open the bond market completely. That to me would bring India into the fold, and really give a lot of confidence both to foreign investors about approaching and coming into India, and also to the corporate sector in terms of the huge outstanding debts that they have, which are no doubt being restructured over the past few weeks, and will continue to have to be so over the next quarter.
Andrew, what about banks then? Is it time for selective nibbling in, or would you still stay away?
No, we've been, doing our usual of renting but not owning. Until I see interest rates come down in India, then there's no need to own these banks. There's too many problems for them. You speak to any good corporate, they'll tell you all of the problems within their own sector, and where the banks are hiding all the problem loans, or not even restructured loans. So all of this will have to, start falling from under the carpet, and I don't think it's going to be a great time for the banking sector in the quarter results that we're going to see in October. So I don't want to own something which, I feel as though a lot of the problems are being hidden at the moment. So until I see, them starting to really show the non-performing loans and the restructured loans, then you're really kind of trying to work out which bank has the worst problems, and it's not a place I'd like to be. When you find that one bank is, non-performing loans are a lot higher than you expected them to be, because the prices will just fall more significantly than we've seen in the recent downturn.
Right, Andrew, always a pleasure to have you on ET Now, and thank you for joining us.